A growing chorus of dovishness across central banks around the world provides breathing space for Asian central banks to implement more stimulus in local economies relative to developed markets. Recently, this dovish theme has shifted from monetary easing to fiscal stimulus. Major Asian economies, including Korea, Thailand, and India, have already unveiled fiscal plans, and we see further room for Asian economies to offer fiscal stimulus. The approach of monetary easing of the Chinese government has been targeted and disciplined so far. Economic growth may slow down further in the near term, and the People's Bank of China may consider more stimulus, both from the monetary and physical side. On the back of more China stimulus and the U.S. Federal Reserve staying dovish, investment sentiment will be boosted and the possibility of an imminent recession is low. One of the main drivers for Asian bonds in the near term will be fiscal stimulus. We expect to see more fiscal stimulus from Asian countries. Combined with an easier monetary stance, this creates a supportive backdrop for the Asian economy. This wave of fiscal easing in Asia may serve as a preview of what may come globally in 2020. The other important driver is China's stimulus. On the monetary front, China has already conducted a few cuts to key interest rates and injected liquidity into the financial system, and we expect this monetary support to continue. A large fiscal deficit and more local government special bond issuance may also come in 2020, which will help to support infrastructure investment. Finally, we expect President Trump to be as market-friendly as possible into and throughout 2020, as he attempts to maximize his chance for re-election. While what he can do is limited, whatever he musters could boost investor sentiment and reduce the possibility of an imminent U.S. recession, further supporting global markets. In terms of fundamentals, Asian investment-grade credit profiles remain strong as companies manage down capital expenditures. The technical side is also supportive, with demands for bonds in excess of supply. In individual markets, we remain positive on China on the back of upcoming policy support. However, are mindful of short-term volatility due to its weakening economy and headline risk. While India's outlook was downgraded from stable to negative by Moody's, we remain overweight as we think a lot of the bad news has already been priced in, and we see positive momentum since the election. We are also underweight the Philippines and Indonesia as valuations look tight. Given strong fundamentals, supportive technicals, and the willingness of Asian central banks to support their economies, we continue to see upside in Asian bonds. The biggest risk is a global recession in the near term, driven by either China doing less than expected, the US offering too little stimulus too late, or a disorderly Brexit that brings cascading negative effect. Any of this could disappoint market expectations and bring on a recession. While credits are likely to sell off when the market catches up with the world's economic reality, a market sell-off should drive U.S. Treasury yields lower. Within Asia, higher quality credits should outperform their peers in the region. This anchors the overall stability of high quality and longer duration bonds, such as Asian investment grade. Changing fundamentals, reduced volatility, and rapid growth in the region's credit markets means there is a huge number of interesting opportunities. with developed market bonds offering negative to negligible yields. Higher yielding Asian investment-grade credits have become harder to ignore. Fundamentals remain sound as Asian corporates continue to see an improving trend on their net leverage, which is driven by a moderation in capital expenditures and mergers and acquisitions amid slower growth. When market volatility exists, the Asian investment-grade bond market becomes more attractive to long-term investors.